Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast that we do each and every week, which can be found and downloaded on iTunes. If you search Real Estate 360 on the iTunes search bar, you can pull up a show, you can subscribe it, download all the past shows that we've done. Or if you just want to go directly to a website, you can go to realestate360live.com. You can actually stream the show directly from the website as well. For many listeners that have been writing in questions over the last 2 months or so, there's an Ask a Question button on the right-hand side of the website. Just click on that, enter in your question, and we're glad to cover questions as we've been doing for the last couple of weeks. Many of you have some very useful questions that I'm sure many other listeners have as well. We're going to cover all things real estate on these podcasts we do each and every week. So from mortgages to credit tips to real estate, whether it's going up or down, or what's the deal with home prices and sales. We're also going to talk about the economy. We're going to talk about the Federal Reserve and the implications of tapering and then buying mortgage-backed securities and treasuries and what that means to you in your real estate decision. So, you're going to get a different view of real estate than you're probably used to hearing in the national media, because our job here is to kind of break down things to a more elementary level and give you the nitty-gritty details that you need to make informed, educated decisions about your real estate. Joining me on our panel, as he does each and every week, is Louis Camrosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert. He's been in many publications, Wall Street Journal, Forbes, Fox, MSN, Fox Money, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you doing today?
I'm doing well, Louis. Thanks
Good.
for asking. So, the last time we spoke, we talked a lot about, Yellen had not yet given her full testimony to Congress, and we talked about how more than likely when she did give her testimony to Congress that she was going to come out and talk about the lackluster economy was a direct result of the weather and that she had to hang her hat on something. But interestingly enough, when she did get to speak, which was, I believe it was yesterday, correct?
Thursday, yeah.
Yeah, Thursday. So yesterday, she came out and, stuck, and it's holding strong to the tune of she's going to get rid of this taper by the fall. However, she did, leave the door open slightly because she said if there's a significant change in outlook, certainly we would be open to reconsidering, but I wouldn't want to jump to conclusions here. Well, Ms. Yellen, I don't really want to jump to conclusions here either, but even if the weather is causing a slight problem, how do you get around just looking at things on the most basic elementary level? We have jobless claims that are going back out of control. Again, they came out. They were higher than expected, up 14,000, 348,000. Testing what they call that 350,000 psychological level, which once it hits there, it seems like everything's getting much worse. But let's not even pay attention to those jobless claims. Let's take all these statistics and just throw them out the window. Louis, you and I both know that things are not turning the corner. I think one of the more telling things that I've read yesterday, J.P. Morgan Chase announced it was going to cut 6,000 jobs in its mortgage operations, and also said that their mortgage division will lose money this year, calling the mortgage business the most painful business ever. Wells Fargo, the biggest U.S. home lender, plans to eliminate 700 more jobs from its mortgage business, and they cut 6,000 jobs last year. Now, the whole premise of the Fed and propping up the stock market and the housing market, it's actually having a reverse effect now because, look, we have this low interest rate environment, Louis, but yet lenders can't make money. So can you explain to me what you think? I mean, obviously we've had this discussion numerous times, but Yellen is going to be forced at probably within the next 2 to 3 months to look at the data because it can't get better, in my opinion. If it does get better, it's just because they made it up. We have the situation over in Ukraine, which is the reason why interest rates.
You got the dogs barking with that one.
Right. Well, and and we talk about this all the time, Louis. There's always a sideshow, some sort of distraction, right? Which always seems to benefit our mortgage-backed securities and bonds, because people move to a flight to quality and testing, trying times across the globe, and we're the beneficiary of that right now. What are your thoughts overall on what Yellen talked about yesterday? And just looking at things at face value, do you agree with me that, obviously things are moving in completely different directions than what she's leading us on to see?
I agree 100%, Ryan, with what you said. And let me add, they're tapering into a recession. They are insisting that the recent weakness of the last 5 years, but they're only saying now the recent weakness of the past few months in the economic data is due to the weather. Well, the forecast for the rest of the year is more weather. So I don't know why they only have another month left of even thinking about blaming the weather, unless there's hurricanes or something else, or tornadoes or earthquakes or something, because the weather is not a factor. The poor retail results in December were before the polar vortexes. The weather wasn't bad across the entire country. Construction jobs were actually up. You would have thought those are the ones that were impacted by the weather. The weather story, the weather excuse holds absolutely no water, and I'm fond of saying that a poor workman blames his tools and a poor economist blames the weather. Now, you mentioned the banks, Ryan. Firing people in the mortgage business. J.P. Morgan, Wells Fargo, that's in addition to the ones they already announced. That was an additional announcement. They're going to lay off more people. If QE can't even create jobs in the banking sector, and that's, QE is supposed to help create jobs, where's it creating jobs? And it's just absolutely ridiculous. And then you've got, this underlying kind of eerie sense of why do you now have, 9 bankers committing suicide or being found dead in suspicious circumstances, many of them related to trading on the Forex, currencies, involved with the precious metals markets. And then there was this mysterious story on, I don't know if you saw it, the Financial Times came out with an article about gold price rigging fears puts investors on alert on February 23rd, earlier in the week. And it talked about how gold prices may have been manipulated on 50% of occasions between January 2010 and December 2013. And it went through all the suspicious circumstances. We're in the middle of the night. Half the world's supply of gold gets sold in 3 seconds, which doesn't make any sense. Any rational person trying to unload a position wouldn't do that. But in any event, the Financial Times then pulled that story, and GATA, which is the Gold Antitrust Action Committee, managed to grab the cache of the story and reported on it, and found out that the Financial Times admitted that they had pulled the story, but really didn't give any reason. And, it's because a story like that runs counter to the narrative that markets are sound, there is no manipulation, and the economy is improving, and so on. And I also, I was just doing a little digging again the other day. I love to see how they spin the initial jobless claims. And as you know, they've been spinning the initial jobless claims in AP, Reuters, and the New York Times. Each time it comes out, no matter what the number is, if it's up from the week before or down from the week before, it always signals some type of increased hiring or pointing to strong job claims. Now, we've been tracking this since August of last year, and they've been saying that whatever number it is signals some type of improving job market. And we've seen from the non-farm payroll that's not true at all. But I managed to see one, the AP had said back in August 8th, and here's what the headline was: breaking, U.S. unemployment aid applications up only 5,000 to 333,000, a level that signals steady job gains. Now, notice in there, up only 5,000. They have to editorialize there. And then they say that 333,000 jobs lost a week and people claiming unemployment claims is somehow a level that signals steady job gains. This week, the New York Times comes out, and the number was 336,000, and it says, headline, unemployment filings decline, signaling strong job gains. It's almost as if they received the same memo, that somehow you're going to say that whatever comes out, signaling strong job gains. When people stop losing their jobs, that doesn't mean, 336,000 people losing their jobs, whether it's 334,000, 340,000, whatever change in that number has nothing to do with whether more people got jobs. So you've got this kind of media complicity in telling us there's a recovery. And another piece of data that came out earlier this week, Ryan, mortgage applications dropped to 20-year low. Okay.
Right.
Can they drop the housing recovery story? No. When they are still saying we are in a recovery, we're in the middle innings, the recovery is going forward, it's just the weather. All the data lines up. People getting fired from banks in the mortgage section. Mortgage rates dropped to 20-year low. Markets are manipulated. The unemployment situation, people are still losing. There's still 350,000 or less in that range losing their jobs each and every week. And they're still saying the economy is improving, there's a housing recovery, the job market, there's steady job gains. And you have to realize that anyone rational looking at the data would say it's absolutely not true. And yet the stock market hit all-time highs. Now, the last time when we had bull markets, Ryan, when the stock market hit those highs in the 80s and the 20s, in the 60s, there was a roaring economy. Not some kind of tepid, recovery that may be happening but for the weather. You would think the markets would at least take some pause and say, well, let's see if it isn't the weather. They don't care. And it's not that the markets don't care. The Fed is still pouring in, even though there's a taper, $65 billion a month. So I think you're right that, she's saying, Miss Yellen is the chair, not the chairwoman. She is saying that we're going to taper no matter what. The Fed president said earlier in the week the same thing. They echoed her sentiment that, we're going to continue with the QE. In fact, one of the Fed presidents basically said, even though the first quarter of this year, this is Mr. Lockhart, Atlanta Fed president, even though the first quarter of this year may turn out to be soft, I'm looking through the recent information to a full year of sustained higher growth, probably just the weather. So they're admitting that the data is weak, but it's just the weather, and they still anticipate, like they do every year, that the second half of the year is when the economy accelerates. And I think this is all a snow job, as you and I talked about, Ryan, that they're going to appear very serious. They'll do 2, 3, 4, 5 tapers, and then something bad will happen, and they'll have gained credibility that they were tapering at the right time, and all this was unanticipated, even though it's not even just unanticipated. The bad data is actually happening, but they're shrugging it off. And when it becomes too much to bear, then perhaps they'll change course and reinstitute the QE.
I agree with you. I mean, it's always like that one line that they slide in there, which she's gonna monitor the data as it comes in. Well, at what month this year are you going to determine that we can't use weather as an excuse anymore? Right.
Right.
Like, is that in July or is that in September?
Well, it gets hot in July, Ryan.
I know, and then it's going to be too hot for people to go to work because they might have heat strokes, right? So they can't go to work. I mean, it's such a weak argument. It's
especially in today's society where we are shielded much from the effects of the weather.
You know what? I think it actually shows how helpless the Federal Reserve is right now. That's the only thing that they can hang their hat on is weather, right? They don't want to actually talk about what's really going on. I mean, I sat there and said, what happens if somebody brings up and we say, okay, look, we have still historically low interest rates around 4%, but yet we have one of the largest banks laying off 6,000 plus people and saying it's the most painful business to be in.
Right. No one is buying houses, and the houses that were being bought were bought by investors and were bought by cash. They were not bought by people taking out mortgages. As that recent data shows, mortgages are at a 20-year low, and now cash investors are also exiting the real estate market. So this real estate recovery has been based on rising prices only and extremely low volume, and that volume is dropping.
Yeah, and, many
it's not because of the weather.
No, it's not. And, we've got a lot of graphs and charts of all these things with existing home sales and existing home prices. And, I believe NAR's 2013, National Association of Realtors, 2013 fourth quarter report showed that prices in different regions, and if you do it as the U.S. nationally, They were up 10.1%, home prices, and they broke it down by region. And then they did home sales, and they broke sales down nationally. Sales were only up 0.8%, but in different regions, like the West was down 8.1%.
But that's down from the year earlier when home sales were not robust.
Right. So we can spin this however we want. And, many people ask me, well, how come it seems like you almost have a negative tune to the real estate market? I don't have a negative tune at all. As a matter of fact, I actively invest in real estate, buy, sell, and update, rehab, renovate. I do all this stuff. So I have to always know what's going on in these markets. But and Susan, just so our listeners know, I advise real estate agents on how to market into this market by doing pay-per-click marketing. So I have no vested interest in the real estate market not doing well. No, and understanding the market, understanding the Federal Reserve, understanding why these things are taking place is critical, because you need to be able to see out 6 to 12 months from now. And obviously this has been something that, Louis, frankly, you and I didn't think that it was going to be this long and still have interest rates near a 4% level. The fact that we still have them, the fact that we have unemployment, which is just absurd right now. I mean, nobody's getting hired. I mean, more people are getting fired. But the main driver of these real estate prices going higher is, like you said, it's people that are buying, investors through cash deals. It's people that are still, obviously still, fully employed, and then they're making their move up. But it's a lack of inventory.
Right. Now, right. That's why the prices are going up. The lack of inventory, and the lack of inventory is based on the last housing crisis, because people are still underwater and really can't sell.
Right. So let's just assume that, it was 1 in 4 homeowners nationally were underwater. Let's just say that went back a little bit. Let's say instead of 1 in 4, it's maybe 1 in 5 now. Okay.
But Ryan, I read a statistic. Even though it may have gone down a bit, the number is actually higher, because effectively, even if they're near or close to not underwater, with the costs involved and then the higher prices of homes, they really can't sell anyway. So you could be technically not underwater, and that number may have dropped, but you have to add back in the people who really, it wouldn't be economic to sell anyway.
Oh, yeah, I agree. I agree with you. And, when we have to physically, when the Federal Reserve and everybody else has to come out and physically say that we're in a recovery, 99% of the time that means that we're not in a recovery, right? You don't have to say that we're in the recovery. We would know if we were in a recovery period. We're the furthest thing from a recovery. We're actually headed, more towards a depressionary environment than anything else.
Recovery is a word that's indicates a temporary state on the way towards something else. You're not in recovery for 5 years. If a patient is recovering for 5 years, he's not recovering.
Absolutely. Yeah.
If you remember the 80s recovery with Reagan, it went from recovery almost immediately to expansion.
Yeah,
didn't have recovery for 6 years during the Reagan era.
Yeah, they can extend recoveries for 10+ years, right? I mean, they can always be going. They can always be going on. And while we sit here and say, obviously existing home sales and all these things aren't that great. At the same time, I tell people that this is still one of the best times to buy, but it's because of different reasons. It's because we have a low interest rate environment where you can lock in low fixed rates, and if you have the ability to take out 10 or 15 different properties all at one time, that's a great thing to do right now. I can't fault anyone for doing that. But most of the time, it's not me saying that, okay, well, we're going to have a 10% price appreciation for the next 5 or 10 years. That's not the reason for doing that. I think that it was an interesting article. I believe it was let's see here, KCM blog, which is Steve Harney is the editor, I believe, of this blog, and he has many real estate agents that actually buy subscriptions to his service on what he feels about what's going on in the market. So he has a vested interest to keep real estate agents happy and feeling very optimistic about the markets. You know what I mean, Louis? So he's always going to be pushing that there's a recovery going on. He gave a story essentially that the housing market is in a full-out recovery, using that word again.
Yep.
And saying that, when his wife and him visited Miami about 10 years ago, they were amazed that there was all these buildings being built with cranes on the beachfront. And then we had the crash, and then, in Miami, property values dropped about 50%, and the buying frenzy cooled off, the cranes disappeared. And he's saying now Miami house prices are beginning to rebound quite a bit. And the last time, and he bought a condo there about 2 years ago, and has already had a nice bump in the value. And now he's saying the cranes are back, so the recovery has to be back. And if I remember correctly, Louis, I mean, the last time that we had this boom, anybody and their mother could get a loan, right?
Right.
Anybody could get a loan.
Much more widespread, 4 times the volume of homes being sold.
Yep. Yeah. So people were willing to risk, buying a brand new condo that hadn't even been built yet to try to flip it as soon as when it's complete, right? I mean, we had stated income, we had no income, no asset loans.
Ninja loans, right?
Right. We had 100% financing, negative amortization loans, and there was infinite amount of loans. Anybody could get it. A 7-Eleven worker could buy $1 million home and nobody would question it. That's not the case anymore. So you actually physically have to qualify for mortgages now, which is also the reason why Jamie Dimon is saying that it's the most painful business to be in, because he can't just give the money out, nor do they want to give it out. He's actually saying, what he's saying there is, I don't really want to be in the mortgage business, but
right.
It's a necessity for me to stay in it because, he doesn't want to lose market share to the other banks.
They wanted the QE, not so they can do better with mortgages. They wanted the QE for the free money and for the bailout aspect.
Absolutely. Keep giving me free money so that I can invest in the market as I see fit, not to lend it out to business owners or average, everyday Joes. That's not what I'm in business to do. I want to keep getting richer. I'm not going to get, I don't feel like I'm going to get richer by lending it out to the middle class. That's not in my best interest to do that.
Well, Brian, you know what a very bad, I thought about this morning. As home prices rise, if the concept of QE is that it creates a wealth effect, and people's stock portfolios go up so they feel richer, they spend money. People's home prices go up, they feel richer, they spend money. It's a foolish concept because there's no production involved. Nothing is getting better. They've just raised asset prices higher, even though the asset is still the same asset. But in any event, if people are actually doing that, and there's evidence that they are, because consumer debt is now up, which is not a good sign. Even though spending is down, consumer debt is up, which means there's not much more consumers can spend if their debt levels have now increased back to levels seen 5, 6, 7 years ago. For a while, homes were reducing their debt. That's not the case anymore. Sorry for the diversion. But if people are spending money in their home because they now have home equity, it's really a farce, because if your home is risen, or supposedly has risen on paper because of the comps, that would make sense if the market was actually liquid and people were trading those homes constantly, and there was a market that if you really did put your home on the market, you would get that price. However, as we know, the only reason the prices are high is because of the low interest rate and the low inventory. But if people were to actually try to sell their homes, prices would immediately start to come down.
Yep.
And if people are spending money based on the fact that their home prices have risen, they're going to be back to the same point they were 7, 8 years ago when home prices come down. Because home prices can't be sustained at this level now, because the only way they can is if they keep reducing the inventory. And this seems to be the trick that they're using, the law of small numbers, meaning, if you just it's the same with unemployment. If you take everybody out of the workforce, you can get unemployment down next to zero. If you reduce the inventory enough, you can make the few houses that are on the market go for higher prices. But those prices are a myth, because if more people try to get that price, they would meet the resistance and the price would come right back down. So that's a threat, I think, in the economy. The limited boost we're getting from this wealth effect of people who are in the fortunate position of having money that they're extracting from their homes because the price has rebounded, that price is fake because they really can't get that price. Other than like in your market, in the Washington, D.C. metro, you probably can. You can sustain more inventory in your markets. People can bring their homes to market and they get sold. But in other parts of the country, that's not true. There's not enough buyers for those homes.
Right. Yeah, and I think, if that, the Washington, D.C. market is an anomaly. And most of the metropolitan areas are going to be completely different than the rest of the country. But, yeah, in most areas here, we have more people fully employed here than probably most areas of the country. And
you do refinances, Ryan?
Yes. The mortgage company that I manage does refinances.
And are you seeing a lot of them based on home equity loans?
Well, we don't do home equity loans direct because those are considered second mortgages. Those those typically you would send directly to a bank just because the terms are not as just nowhere near what you would get if you just went direct to a bank or a credit union, right? Because they tend to specialize in those type of things, and it's mainly because they're getting money so cheap from the Fed, and they're lending a lot of the times off of deposits and other things like that they can give you the best deal. But are you? I don't
know why I asked you doing refinances, but I'm asking is, are you seeing in your area people taking home equity loans out at a higher rate in the last year or two, even though you're not in that business?
Absolutely. Yeah, and it's because it's as society. What happens? You get some money. What do you want to do with it? They want to blow it. They want to blow it on. Maybe it's a new deck, a finished basement, a patio. Whatever it may be, but as soon as they get it, it's got to get spent. And very few. Now, that you do have some people that are actually taking and they're saying, "Oh, I got some equity in my house. I'm going to sell it, and I'm going to buy the bigger house." And that's taken place a lot in Northern Virginia and D.C. metro area, where people are making those next moves up if they can.
That's a good thing in a market, assuming that there's a market for the lower price homes for first-time home buyers. But as we know, there are not first-time home buyers in the market. They've dropped to an almost all-time low level of about 26%.
Yeah, there was some interesting article on first-time home buyers and why the rate of first-time home buyers is so low. And they had this argument that many of the first-time home buyers are preferring to live in apartments now versus actually
a lifestyle change, not because they don't have the money.
Yeah, I'm like, give me a break, okay? The reason why people are buying as first-time home buyers is because they're probably still trying to figure out if they're going to go to another 2 years of school or if they're going to continue for another year of not having a job and looking for a job, right? That's really what's going on here. And
now, that may force a cultural change, but it wasn't a cultural change of choice.
Right. So, something's got to give here, though, Lewis, which is an interesting thought for me, because when you start to see, like, J.P. Morgan Chase, they're getting rid of all these people in the mortgage business, which essentially means that they're not able to qualify as many people to buy houses, and they're losing money. Eventually, these banks get their way. So what tends to happen when we have these in the regulation, I've already seen that there's people that are trying to create lawsuits to come after the CFPB because they're saying that the only reason that they're even there is just to fine everybody and their mother just because they think that, they want to make some money. The CFPB basically just does whatever they want. They go in and you're going to be paying them money when they come in to audit you. They're going to find something wrong. So it's like this rogue agency, you know what I mean, that was just created out of just to basically steal money from companies. Essentially the way I look at it. But at some point, something has to open up, and typically what that is these guidelines have to start to loosen up. Now,
that only helps so much.
Well, it only helps so much, but the way that I'm looking at it is it could be one of these things where one of the main guidelines, like something like employment history, where they're looking at like a full 2 years at a job, they might really come back and lower that down to a year or something. They're going to have to get creative because otherwise, you're going to have a continuing trend of basically investors and people that are in metropolitan areas that do have stable jobs, not the rest of the country. This is going to be really the only people buying houses. And you brought up a good point about rising prices. One of the biggest buyers of homes and non-performing notes are hedge funds.
Right.
They're the ones that are holding these things. So when we talk about a low inventory environment, hedge funds are very smart. They're very smart. What do you think they're going to do if they know that homes, especially in metropolitan areas, that's why they want to buy in like Boston and New York and D.C., because they know that these areas have many more jobs than the rest of the country, so the home prices are going to continue to rise up. They're going to hold their inventory. They're going to hold it. They're going to let the prices continue to rise until they start to see where there's more inventory coming to the market, and then they're going to unload them.
It's the same with, the banks do the same thing. They're now working with the hedge funds, I guess, is banks are holding on to inventory because they're allowed to hold those mortgages at the original value, even though they'll never see a dime of it. So it works to their advantage to hold back inventory as well.
Yeah, and
and it's interesting. It takes the dynamic, just like the Fed has taken the market participants' ability to read market signs and basically have substituted itself for what to look at. This is happening now in the housing market. It's not just a function of, it used to be, what are interest rates? What are comparable houses in the market? What's the employment situation there? Is it a good neighborhood? Are the schools good? That determined price. Now it's determining price are investors. They're coming in with hedge funds, and they're helping to determine the price because the inventory is now determined not from supply and demand, but whether the banks who hold a lot of foreclosures or whether the institutional investors like BlackRock and American Homes for Rent and all the others are going to sell their homes or not. It's not a normal market where it's between individuals who own homes and either want to buy or sell them.
Yeah, I mean, just the other day, Lewis, I had somebody message me through, I don't know if it was LinkedIn or Facebook, one of them, and was just saying, hey, I just started up my new fund. I'm looking for properties in these areas. And I'm like, what I always tell people, typically when people start coming out with this stuff, like it's something new, they're typically late to the game, right? I actually was studying up non-performing notes and selling non-performing notes back about 4.5 years ago, okay? That's when the ex-CEO of Countrywide actually left Countrywide and created essentially like a hedge fund to basically buy the same bad loans that he was giving out, right? Created Condor Capital, which now Condor Capital is kind of falling on its face. So to me, everybody
was Vulture Capital taken?
What's that?
What's the name?
I think it was. I think it definitely was. But so now when we have basically the everyday folks now talking about buying bulk foreclosures or bulk non-performing notes, it's too late. This stuff is already baked in at this point, and that's where I'm more scared for what's going to come down the pipe for home prices. Now, like I said, myself, I can invest in real estate in all types of markets, whether it's high interest rate environments or a low interest rate environment, low inventory, high inventory, because I understand that it's buying strategically, it's buying for cash flow.
There's money to be made in every market.
There is. It's just like there's money to be made in the stock market, whether it's going up or down. And most people's financial planner is making money regardless of what your portfolio does, right? So, you can make markets. You can make your own market if you know what you're doing. Now, for the everyday person that's just looking to go out there and buy, a home for themselves, the primary residence to live in, I always tell people, just remember, this is your primary residence. This is not an investment property, so let's not treat it like that. Because I think that's what most people do. They look at it and they say, well, I want to buy in an area that, it's going to hold its value. It's going to increase at 3 or 4%. And I'm like, well, that's just not realistic. How long do you plan on living here? Well, I don't know, 10 years? Well, how much can change in 10 years, Lewis?
Of course.
We could go from 4% to 14% in 10 years, and nobody would see that coming. So if you can just protect yourself by taking a fixed rate, you really don't have to worry about all the other stuff, whether your value goes up or down. Because to be honest, at the end of the day, you could have that loan paid off if you wanted to, and probably somewhere close to 19 years if you made one extra payment per year and not even have a mortgage payment.
If the primary purpose of buying the house is to reduce your cost of shelter and to lock in a fixed cost, then you won. If you try to bring in other variables about the investment value of it in 10 years, that's a different analysis.
And I think from the last boom that we went through, the last housing boom, a lot of people made a lot of money off houses, and I feel like they think that this is it all over again. And it's really not. It's not, because like I said, there's not the ease of access to money like there was last time. Now, there's not the ease of access to money for the average person. Correct. There is for the banks.
And the institutional investors and the hedge funds, right.
Which is why we've seen, such a, substantial increase in prices. Like you said, it's just the main drivers is the low inventory.
It's a transfer of wealth to those that already had, decent equity in their homes, but really they're now giving the large institutional players a piece of that wealth. And they're de-risking it by now creating these rental securities where they now are issuing securities based on the projected rental income of all the homes they bought at distress levels and now are trying to rent out.
Right.
So they're basically taking all that wealth, which was one of the few things that the middle class had. They didn't really have stocks, but they had their homes, and if they bought a home and continued to pay their mortgage, they developed equity in their home, and they at least had a nice asset that was worth something. Now, for most people, not most people, but 25-40% of people, they live in a house where they owe money.
Right.
And, the rest of the people, then 30% of the people rent. So you've basically taken equity away from more than half of the people that live in homes.
Well, one of the questions that I get asked all the time, Louis, is...
So as a middle-class person, do you put money and actually come out ahead? It's not putting it in the bank.
No.
And maybe it's not buying a house.
Great. I mean, it just depends on what somebody's, investment objectives are.
But you just said that, buying a house may not be an investment objective. Right.
It may not be. And for everybody, it's different. I mean, like I said, I run across deals all the time where, if an investor was looking to invest in real estate, they could cash flow somewhere between 13 and 15%, right, on certain deals. So when you look at it in those terms, you're buying a real estate for the pure, investment versus somebody that's like, oh, well, I'm going to buy this house, but I'm also going to maybe rent out my basement and have some rental income. But I'm not really sure if I'm going to do that. But I think it's just going to be my primary residence. You can't get caught up in the valuation of that home 5-10 years from now, because any real estate agent is actually doing you a disservice of trying to project where they see your home value going in 5 years.
Well, they're not trained to do that either. I mean, the real estate agent is that's not their job.
And you can't even, very few people have ever been able to guess these markets correctly for 5-10 years out. I mean, it's pretty much darn near impossible to do that. Mainly because we don't have a free market here, right? We have
even in a free market you couldn't tell.
Yeah, well, even in the free market you couldn't. But now that you have an artificially manipulated market, it's even more difficult because
they can manipulate whenever they feel like it, for whatever reason they feel like it, in ways that make no sense whatsoever.
All right, they can turn the spigots on, turn the spigots off.
Right.
They can create more regulation, take away regulation, print more money. I mean, there's so many things that they can do.
They can do bailouts. They can do bail-in. You have no idea what they're going to do, and whatever they do is going to impact the market, and you can't predict what they're going to do.
Yeah,
long term. Short term, you and I have been pretty good at knowing what the Fed's going to do, but we don't know who's going to be on the Fed 5-10 years from now and what they're going to do. Whether there'll be a Fed 5 years from now, what it will look like.
Yeah, we're still trying to pick up what Yellen's patterns are going to be, right? I mean, she just took office, so we're going to have to pay attention and figure out what she's likely to do and not do.
And she has a 4-year term, right? And she may not get re-upped, or maybe she will.
Right. She may not. But the one thing that I can tell people, if you just make decisions based upon where you're at today, meaning like you're just looking at things for face value. Can I afford this home? What is the interest rate? Can I get a loan for it? Okay. Sounds like you can make a good decision based upon your payment, what your interest rate is going to be, and whether you need to move or want to move, or you just want to rent. I mean, you have basic options. Just look at them for face value. Don't get caught up in where things going to be 2, 5, 10 years from now.
Ryan, you've always said, and it sounds counterintuitive from someone like yourself who thinks about the future, who analyzes it. Your advice has always been, can I buy this house now? And do I need this house now? Will I need it? If so, buy it.
Right.
And you've simplified the decision by not trying to project the future, because if you're advising someone to buy a 30-year fixed house on a 30-year fixed mortgage, you really don't have to worry about the future in the same way. You've basically eliminated a lot of that future speculation if the primary reason for buying it is to lock in your cost of shelter.
Correct.
And your point is, if you have a job and you can afford it, the rest is speculation that you have advised your clients you don't need to do.
Yeah, I mean, most people are not investors, right? So why should they be speculating,
And if you're going to speculate, go buy futures on the stock exchange.
Exactly.
Go buy Bitcoin. Do something. Don't speculate where you're going to live.
No, and you definitely don't want to be speculating on a place that you plan on buying for your family to live there, but the primary reason is because you're trying to get another 15% equity built up in that property over the next 2 or 3 years. Because what happens when that doesn't happen? Then you have a sour taste in your mouth, and you're like, well, why did I buy this property?
Well, what if you bought it on using a fixed an adjustable? Yeah. Exactly. Yeah, I was trying to use the word adjustable. You could just say ARM. If you buy an adjustable mortgage, and then you can't make the rates go up, and you thought it made more sense to kind of chisel some of the payments down lower, and then you have to move your family out in 3 years because you can't afford to stay there anymore.
Right.
Well, what was the point of that? I mean, you could have speculated money and not lost the money in the stock market, but not lost your primary residence as a result.
Yeah, I agree with you. And and this is where it kind of shows you the difference. Investors, when they invest in real estate, a lot of investors will take out adjustable rate mortgages, right? So, like, I have one on one of my rental properties that I have an adjustable rate that I've had an adjustable rate on since 2004, and it started at 3.5%. The highest it ever went was 6.5%, and right now it's 2.75%. Now, as people may see, I have some pretty good cash flow on that rental, and I have but essentially what's taking place there is as that rate was continuing to go down, I was collecting those same rents. I was able to, I can keep paying that mortgage off. I have somebody else paying that mortgage off at a very high rate. I understand the risk that's associated with that adjustable rate mortgage. I'm investing in that real estate property for cash flow.
But Ryan, if you actually make the wrong bet and lose it, you don't lose your place to live.
Correct. Yeah. I don't. And I'm not, I wouldn't gamble with something like that with my primary residence.
But that's what some people are doing.
Right. And especially knowing that I want to stay in this house for, 10, 15 years. You know what I mean? I don't want to put myself in a position where I might have to say, you know what, I'm stuck. I'm just going to have to let this house go. By shoring up things and kind of knowing where the only things that are going to change on a 30-year fix are your taxes and insurance, and that's probably going to be, not too much one way or the other over even a 10-year period. Now, granted, the counties are always raising taxes one way or the other. They're either lowering the tax rate or raising the tax assessment, right? They always find a way to get more money.
Right.
But outside of that, your largest cost is your principal and interest payment.
Absolutely.
So it's smart to lock in your 30-year fixed rate, especially at the levels. Honestly, guys, interest rates are near 4% again. You could probably get them lower if you wanted to pay discount points. But it's incredible that they've stayed this low for so long. I hope that they do stay, it's somewhat low for people that haven't been able to take advantage of it, because, there is the flip side to the coin, Lewis, where there's been a lot of people that were buying, that were first-time home buyers that did take advantage. Now, that's not a large percentage of the population, but then there was many people that had always paid their mortgage payment on time. They bought their first home in the boom. They're upside down. They're still working, but they can't even put themselves in a position to be able to buy another house. You know what I mean? For those people, I actually feel kind of bad, because it's like they've been making their financial, obligations. They've been meeting their financial obligations ever since that took place back in, 07, 08, and they were just hoping to get their head above water. I hope interest rates stay low long enough for them to maybe be able to capitalize. Maybe this spring some of them will be able to come out. I know that, still 1 and 4, 1 and 5 is underwater.
But the Fed has said that they're going to keep interest rates low irrespective of the tapering or ending of QE. I don't see how they do it. Who's going to buy those mortgage-backed securities? Who's going to buy the US Treasuries at the current low price? Although we did see, Ryan, that as we're tapering and China's saying they're not going to buy anymore, and Japan has probably slowed its purchases, Belgium was the big buyer last month, and I guess Belgium is the EU stepping up to the plate, and maybe they're going to print money and use a lot of that money to buy US Treasuries. So we'll just shift QE from the U.S. over, because Europe has not really done QE yet. So I suppose if they start doing QE, they can supplement our QE over here and supplant it, and just keep shifting it around the world, and maybe then it'll be Japan's turn to print money and buy European securities in 5 years.
Well, Louis, I'm sure there is a master plan that's
there has
bigger.
to be. They're not just going to stop buying $1 trillion worth of securities a year and have no buyer lined up.
No, it's not going to happen. And I think
some other central bank is going to be forced to pick up the slack.
Right, and I think that's why Yellen and the Fed can come out so sternly and say we want to be done with this taper by the fall.
And we're scratching our heads saying how? Who's going to buy these securities? Because the U.S. has deficit spending that it needs to do. Because they just said they're raising the debt ceiling. It's not like the United States Congress has said we're going to cut the spending and therefore we don't have the need to issue as many U.S. Treasuries. They said they're going to increase it and there's going to be no problems whatsoever. They're going to spend the money. Well, how are they going to spend it unless they issue debt securities? And if the Fed isn't buying them, remember the Fed's been buying 70 to 90% of the newly issued ones for the last couple of years. Take them out of it. Who's going to buy them? We've been speculating that maybe U.S. citizens will be forced to buy treasuries. That's not really in the cards yet. Maybe they're starting down that path with the Obama myRA plan, but there's nobody in the next 6 months that's going to be able to buy them unless they've already got them lined up, and maybe that is. The European Central Bank will do QE, they'll print money, and half of it will go to the United States Treasuries.
Yeah, I mean, I'm sure that there is, and we'll find out, obviously, probably in the coming months. We'll just have to monitor and see who's buying what. Or
it'll be the Fed. The Fed will just stop the QE and go back. Stop the tapering and go back to QE.
Yeah, well, you and I we've been kind of saying all along, really, what we don't have anything that's really saying that, hey, the economy is positive, we have more production. GDP comes out today, and they're expecting it to be lower than expected.
Well, that's the revised GDP, right?
Oh, yeah, the revised GDP. So,
of course it's lower.
Right. It doesn't take a rocket scientist to figure this stuff out. I'm just waiting, first for the weather to clear, Louis. I want the weather to clear first.
Well, there's going to be weather. There's no two ways about it.
Yeah, but I'm really curious to see kind of what transpires in the real estate market through this spring. I want to see if there is that influx in inventory that I've been waiting for. I want to see if it's there because that'll kind of tell me a little bit more about what I think is going on. But if it stays with this low inventory environment through the spring again, then, these prices will probably continue to tick upward in the metropolitan areas. Now, I'm not going to say it's going to happen throughout the rest of the country, but it's something that, it's worth keeping an eye on. I did want to, we're coming towards the end of the show, but I did want to give the credit tip for this week because it was actually a question that I had from a listener a couple weeks ago, and they had asked, when you're applying for a mortgage, and many people have cell phones, right? And they want to know most people have cell phones at this point. Kids, everybody has them. So they want to know, how come my cell phone doesn't get reported on my credit report, right?
Well, don't you have to give a credit application? You have to give some credit information to get a cell phone, don't you, under contract?
Correct. So typically it's the person that is account that it's going to be under. Like if you had a family plan, Louis, you might just be the only person, right? So it would just be under your name. They're going to pull your credit. You're going to pull your credit, make sure that you're credit worthy before they give you that phone in the service. Well,
it was done years ago, but I remember that you have to go through some type of credit check. You don't just take out a phone.
Yeah, well, and the crazy part about this is, so the way that these phone companies work is that they're not going to report anything unless it's negative on your credit report. Because essentially, creditors, whoever it is, they have to pay money to the three bureaus to be able to report information to them. So the cell phone companies have basically said, well, I'm not going to take the time to report every single month when somebody pays their cell phone bill on time, but I will take the time when somebody doesn't pay their phone bill to report them and report them to collection and put that derogatory remark on there. Now,
how is that different than a credit card? Because on your credit card report, on your credit report, they show your credit cards. You're saying they don't show the phone bill.
They don't show the phone bill on there. All they've
as
done
paid.
Your credit. Yeah, they don't show it as paid.
Balance at zero.
Right, and people are kind of frustrated. Well, it's like, how come they can report negatively on my report if I miss the payment, but they can't report positively if I pay it on time. And that's
like you do with your credit card.
Correct. But here's the thing, Louis. Even a credit card company has the opportunity to not report if they don't want to. Matter of fact, I've known small banks that just don't want to spend their money to the credit bureaus to report to them at all. So,
but your credit card on the report, Ryan, from what I've seen, it shows you've had the card since 2006, and it just shows that it's been paid.
Correct. It shows it's been paid for how many months it's been open.
Correct.
It'll have like account number and all that. And sometimes those credit card companies, there's 3 credit bureaus, they might only report to 2 of the 3 because every one that they send information to, they have to pay, right? So a lot of the time it's just a monetary decision as to whether they're reporting to all 3 or not. But the phone companies, they don't do any of that. They're only going to report when you basically don't make payment and get sent to collection, which is obviously going to show up negatively on your credit report. So knowing that, what's the best advice that I can give you guys? Well, I think that it's unfair that they don't report that it's, when you have a positive account.
Yeah, you've had it for 10 years, the same phone number, same payment.
Yeah. What I'm telling you is don't miss your cell phone bill payment. Don't go into collection because that's obviously going to pop up on your credit report. That could hinder you from being able to buy a house. Now, the second part to the question that this person had was, well, could I potentially get that added on as like a non-traditional credit if I've been paying that on time? Now, you can, for like if you're trying to get a government loan and you don't have any credit established.
Wait, repeat that, Ryan?
If somebody wants to get a trade line added onto their credit report,
okay,
right? Like let's say like a cell phone bill, or let's say automobile insurance, right? Or you've paid rent on time for 2 years. It's called non-traditional credit, and you can actually get this stuff added onto your credit reports, okay? You actually need to work with somebody that really knows what they're doing. But let's say that, you have a borrower that doesn't have any credit right now, Louis, and then their spouse or their fiance, they're looking to buy their first home together. The one person has 680 credit score, but they both want to buy the house together and they want to use both incomes. Well, they have some programs out there where you can use non-traditional credit where you can actually add on things to the credit bureaus where basically you'll send the information to the credit bureaus and they're going to validate these accounts, whether it's making rent on time or paying your automobile insurance for however many months you've been paying it. And they'll add it onto your credit report, which will actually generate, it won't be like a top-tier score because you don't have revolving accounts and all the other ones, but it is that you will be able to show some credit history that you paid some things on time. This is kind of an interesting thing because most people think that they're down and out when they don't have a credit score, but there is some alternatives. So cell phone bill, auto insurance, payment to a landlord for rent, if they can be verified, and sometimes they may require canceled checks or things like that, but yes, you can get them added to your credit report and it can help with your credit profile to potentially be able to buy a house. Many people didn't know that, Louis, but, that's just something else, one of those,
That's a good tip.
Yeah, quick tips that could help somebody buy a house. We're coming up on the end of the show, Louis. I want to thank you again for coming on. Tell our listeners your blog again so they can check out your weekly blog posts that are fantastic, by the way.
Oh, thank you. It's smallgold.com, SMAULGLD. As Ryan mentioned, we have between 1 and 3 blog posts a week, generally about the economy, about real estate, gold, silver, sometimes Bitcoin, anything that may impact what's going on in the economy. It's SMAULGLD. There's also a Facebook page, and you can follow us on Twitter at smallgold.
Awesome. I appreciate it, Louis.
Thank you, Ryan.
Thank you guys for tuning in. Remember, if you have any questions for us for the next show, go to realestate360live.com. On the right-hand side, there's an Ask a Question button. Click on that, enter in your question, and download and subscribe to us on iTunes at Real Estate 360. Talk to you next week.